Take a look at this chart. If I asked you to mark the highs and lows, which ones would you pick? These? Or maybe these? Or these? None of these answers are wrong, but you need to have a consistent method, because without a consistent method, you can't backtest, and trading without backtesting is just gambling. And so in this video, I'm going to show you 4 of my favorite objective algorithms to identify market structure. Each algo has different pros and cons, and by the end, you'll know which method to use in every situation. And as usual, all the code is linked in the description. The first algorithm is called directional change. As the name implies, the idea behind this algorithm is to quantify when direction changes, and it'll only confirm a high or a low once prices started moving in the opposite direction. Let's look at an example. The algorithm starts by looking for a high. As price moves up, it tracks the highest closing price seen so far. That level keeps updating as price makes new highs. But before the candidate high is confirmed, price has to reverse by a minimum threshold. This minimum threshold is our only parameter. Let's say that in this case, we set the parameter to 10. The orange line is our threshold, and once price closes below this line, the last candidate high is confirmed. Now that we have a confirmed high, the algorithm flips and starts looking for a low, and the candidate low will keep updating until we get a price close above the orange line. In this example, I'm using a fixed threshold, but you can also make the threshold adaptive. Personally, I like scaling this threshold by the average true range. That way the algorithm automatically adjusts for volatility. You'll also notice that I use closing prices here rather than highs and lows. And that's a deliberate choice to keep the example as simple as possible. But you could modify the code to use highs and lows instead. And this is true for every market structure algorithm, not just directional change. There's an argument to be made that using highs and lows is the more natural way to identify swing points, but the trade-off is that the code becomes more complex. If you decide to use highs and lows, you have to handle the edge case where a swing high and a swing low occur on the same bar. So that's how the directional change algorithm works. Of the 4 algorithms I'm showing you today, this is probably the one I use the most, and there are a few main reasons for that. The first major advantage of this indicator is that it doesn't repaint. That might sound obvious, but it's actually a really meaningful property. Some detection methods will retroactively move or delete swing points as new price action is added. With directional change, confirmed swing points are locked in permanently. The second thing I like is the alternating structure. The output is always a clean sequence of highs and lows. Every confirmed high is followed by a confirmed low and vice versa. This is honestly a surprisingly rare feature in detection methods, and in my experience, it's very useful. And that also brings me to my third reason. The alternating structure also makes this algorithm particularly useful for live trading, especially for reversal strategies. The confirmation of a swing point can be a really simple and effective trigger to enter a trade in the opposite direction. And the last reason I like this algorithm is that there's only one parameter, the confirmation threshold. By adjusting it, you're essentially controlling the sensitivity of the detection. A larger value means only the most significant swings get confirmed at the cost of slower confirmation. A smaller value gives you more swings with quicker confirmation, but they'll be smaller and noisier. One parameter, one intuitive trade-off. Algorithm 2 is the rolling window. This is probably the simplest possible approach. For each bar, you look at a fixed window of bars to the left and to the right. If the high of the center bar is the highest in that window, it's a swing high. If the low is the lowest in the window, it's a swing low. Not very complicated, and it doesn't repaint, which is a big plus. The only parameter is the window size. A larger window means fewer swing points and a slower confirmation. A smaller window means more swing points with quicker confirmation at the price of introducing more noise. It's the same basic trade-off as with the directional change algorithm, except this algorithm determines swing points based on time rather than price. The rolling window has one major strength, which is that lag is always fixed and predictable. For example, if you set your window size to 11, that means the algorithm always needs to wait 5 bars before confirming a swing point. You could also think of this lag as a limitation, but every indicator has lag. And having fixed lag is very useful when it comes to backtesting. Knowing how delayed your signal is can be really insightful for strategy development, and that's mainly what I use this method for. The third algorithm is called like and subscribe. Okay, it's not actually called like and subscribe, but you should do it anyway. Thank you. The third algorithm is really called perceptually important points, or PIPs. The idea behind this method is to algorithmically replicate what your eye does naturally, which is to look for the most visually prominent turning points on the chart. The way it works is as follows. You start with two anchor points, which are always the first and the last bar of your look-back window. Then it draws a line between these anchors and looks for the point in the data where price deviates the most from this line. That then becomes the next point. Now we draw new lines to connect our 3 points, and we again look for the data point with the longest distance to either line. And it will keep iterating through this process until it finds the specified number of swing points. So that means that this method requires two parameters. The first parameter is the window size, which is the number of bars in the dataset, and the second parameter is the number of swing points. Unlike the other methods, you're directly controlling how many swing points you get in the output, which is a fundamentally different way of thinking about the problem. The main selling point of the PIPS method is that it most closely matches human perception. The swing points it identifies are probably the same points that most other traders would have marked on their charts. So for things related to pattern recognition, I'd choose PIPS over the previous two methods. Being able to automate this human identification process has two major benefits. The first is that it eliminates all the guesswork, which will make your trading more consistent. And the second benefit is that it enables proper backtesting of pattern-based strategies. I've heard many traders make the argument that their strategy can't be automated because it relies on human behavior, but I think PIPS solves that problem pretty well. It does come with one significant downside, which is that it repaints. As new price data is added, the anchor points shift, and the selected swing points can change retroactively. This makes it unsuitable for live execution. I personally use PIPS mainly for data mining chart patterns and training machine learning models. Repainting is not a major concern for those use cases because the look-back window is fixed. The fourth and final algorithm is called persistence-based detection. This is probably the most mathematically sophisticated of the four, but the core idea is pretty intuitive. Imagine the price chart as an underwater mountain. As the water level falls, every local peak eventually breaks the surface and becomes an island. When the water level reaches a valley between two islands, these two islands merge, and the shorter one disappears. We can then define the persistence of a peak as the distance that the water had to drop before that peak's island got absorbed. A large peak survives for a long time, but a small peak disappears almost immediately. This example shows how the peaks are calculated, but the process is the same for the lows, just the other way around. So the result of this approach is that every swing high and swing low is assigned a persistence value. Now that we calculated the persistence values, we can filter by a threshold to keep only the swing points that we're most interested in, which are usually the ones with the highest scores. In my implementation, I normalize that threshold by ATR so it automatically adapts to current volatility. That gives you a single intuitive parameter similar to directional change. But overall, this approach is more similar to the PIPS method. Just like with PIPS, persistence-based detection does repaint. A peak's persistence score depends on what comes after it, so the results can change as new data is added. That's why I wouldn't use this method for live execution either. But I do think that this method can be a compelling alternative to PIPS for data mining and machine learning applications. There are three main differences between the methods. The first is that the selection criteria are fundamentally different. Persistence selects for structural significance, while PIPS selects for visual prominence. Those two concepts are related, but definitely not the same. Another difference is that with the persistence method, you don't need to specify the number of swing points beforehand, and instead you only apply a threshold and let the data decide how many swing points there are. And the last major difference is that the persistence approach isn't constrained by anchor points. I don't necessarily think that one method is better than the other, they just interpret market data in different ways, which is not a bad thing. So those are my 4 essential algorithms for market structure detection. If you found this useful, please like and subscribe. As always, all the code is linked in the description. Thanks for watching, and I'll see you in the next one.